What if we could generate monthly dividends by simply holding one ETF that is globally diversified, pays out monthly, and yields over 8%? In this video, I'm going to show you how, weigh up the pros and cons, and help you decide whether it's worth adding to your portfolio. When looking at dividend ETFs, we can split this into two categories, passive and active. Let's start with passive. Now, these can be quite hard to find because most companies will pay out either annually, semi-annually, or most likely quarterly. So to find a passive ETF that tracks an index that also pays out monthly is going to be very difficult. You're either going to have an ETF that is going to be very varied in its payments because you're going to have some companies paying obviously in different quarters, or you're going to need some level of active management in order to smooth that income out. There is one you can use though, and I'm going to show you how to find it. To do this, we're going to use the ETF screener on justetf.com. From here, we're going to filter by a few different metrics in order to filter it down to a small number of companies that we can analyze. First off, we're going to simply select equity. From here, we can select different regions, countries, sector, but because we know we want to go into a dividend ETF, we can simply select dividend in the equity strategy. We're already down to 79, but we can filter it by a little bit more. The first we're going to do is simply older than 1 year, so we can make sure it's got a track record. Then we've got use of profit, so accumulating or distributing. We obviously want to make sure that the fund pays out the income, so we select distributing. Then fund size, I'm going to select larger than 100 million. Just to make sure that there's no liquidity issues and the fund is a reasonable size. We know it's got the reputation behind it. That's brought us down to 27. And if we were simply just looking for a dividend ETF, then this is a great place to start. If we weren't bothered about when it pays out, then this is a really good place to look. These top two here for an overall dividend ETF can be great choices. So from here, we need to find the funds that pay out monthly. Unfortunately, on Just ETF, you can't filter by when it pays out the dividends. You can click into each one and see what it does, or you could use another screener tool or AI to filter them, but I'm simply going to tell you. It's actually really simple, and it also happens to be the highest yielding one here. So if you sort by dividend yield and you look at this fund here that pays out a 9% yield, the Global X Super Dividend Fund. Now at first glance, this looks really good. It's got a dividend yield of 9%, pays out monthly, and it's got positive growth. But actually, when we dig a little bit deeper, it's got a few red flags, which means I actually wouldn't recommend this fund. First, let's have a look at that performance. Now, a key thing when you're looking at performance figures, when you look at ETFs, they generally always include the dividends included. And remember, this has got a yield of 9%. So when we look over 3 years, you could look and see it's done 12.56% and think, oh, that's really good results. And I've got my dividend yield, but it's including dividends. When we take the dividends off, it's actually close to nearly a 20% loss. So even though we're getting 9% per year, our actual capital is going to be falling. And this would be the first red flag for me, that you've got a really good yield, but it's at the expense of capital erosion. The fund has done better in more recent times. So if you look over a year, it's actually done 3%, including the dividends is up at 13%. So there is potential that this fund has had a bit of a crash and it now is recovering. But for me, it's too volatile. When we're looking for a dividend ETF, you want some level of consistency, because if you've got such volatile fund, your payments are going to be all over the place. And for me, I want to see a little bit more of a track record where it's a little bit more stable before I'd look at a fund like this. We can also look at the objective of the fund, and it simply tracks an index that tracks high dividend stocks all around the world. So because it hasn't got that active element in there, the index has simply picked stocks that have a high yield, which again is another red flag. And then the final two things would be, if you look at the countries by weighting, you'll see countries like Hong Kong, Brazil, South Africa, and China, which do have a lot of potential, but they will add volatility. And then the final thing, if you look at the price, is 0.45%, which could be seen as slightly expensive for a passive fund. So overall, I think if you're willing to accept that volatility and willing to take on a little bit more risk, then this could be a good fund. It pays out a really appealing dividend of 9%. It looks like it's recovered slightly, especially in the last year. But for me, if I'm looking for a monthly dividend, I want some level of consistency, and that variation just would put me off. So now let's look at active ETFs. So we're going back to our screener, and if we scroll down to the bottom, instead of long only ETFs, we now choose active ETFs. We're then going to select equity, and then we're going to select two of the same filters we used before. So distributing and a fund size of larger than 100 million. So that brings us down to just 8. JP Morgan have been a big player in this in the last few years. They've grown massively in the number of active ETFs they have, and they are growing in popularity. So the 3 that we're going to look at, and the only 3 that actually pay monthly, is this one, and this one. So we've got one that focuses on the NASDAQ, one that is a global equity, and one that focuses on US equity. And you'll notice both the NASDAQ and the US equity one haven't got a dividend yield showing here. And that's because they're less than 1 year old. That in itself shouldn't put you off investing into them. It just means you've got less of a track record and less data to analyze them. For me, the first thing we need to decide is where we want that exposure. We can start with a global approach, which is going to be the most diversified. We can then narrow that down a little bit further to just go US equity. And then we can narrow that down even further just by going NASDAQ. And we've seen over the past 5 years, if you compared a global index fund, an S&P 500 and a NASDAQ index fund, the NASDAQ fund is going to outperform both the S&P and the global. And S&P has also outperformed a global index. But you are going to take on more volatility, and there's no guarantee that outperformance is going to continue. So going back to our previous point about when we want a monthly dividend ETF, we want some level of stability, but we also want diversification as well. We don't want to take on loads of risk in terms of the capital. We're mainly focusing on a stable dividend yield. And for that reason, I would simply just focus on the global equity version. Now, I don't just like this fund because it's the only one that pays monthly dividends and because we like the global exposure. There's actually a lot of things to like about it. The first is the objective of the fund. It focuses on developed markets. So we know that developed markets are slightly less volatile than emerging markets. And it also focuses on undervalued companies. So the research that's coming across the equity desk, they're placing an active bet on which companies they feel is undervalued and have got growth potential. And they also use derivatives to generate more income, which we'll come on to. Performance-wise, it's been okay. We are slightly limited in the fact that this fund is less than 2 years old. It launched in November 2023. But we can look over the course of the fund's life. And if we take out the dividends, it is slightly down, more or less flat, but I would look at this from a long-term perspective because the equity desk is focusing on companies that are undervalued. It could take them a while before they come into profit or they start to grow. So you've got to have a long-term approach with this fund. The current dividend yield is 8.2%, and it also pays out monthly. So exactly what we're looking for. In terms of country exposure, it is slightly weighted towards the US at 60%. But I would say this, if you're looking at a global equity index, you're going to have exactly the same exposure to the US. So this is no different to just investing into a standard global index fund. It's fairly evenly weighted in terms of sectors. It's got 239 companies, and there's not one sector that is massively overweight. Now back to those derivatives that I talked about and why it's able to generate so much income. It uses what's known as covered calls. This is essentially financial engineering that converts volatility into income. It sells call options, which is a contract giving its buyer the right but not the obligation to buy an underlying asset at a specific price, the strike price, by a certain date. It sells these call options for a premium, and that's where the extra income comes from. With the call option, they'll set a strike price, and the buyer of that call option has the right to buy that stock at that given price. So if the stock was to increase in value, then if it's above the strike price, then that's what's called in the money. And that means the buyer of the option can simply buy the stock at the strike price, and then they're immediately in profit. It means the seller of that call option has to sell the stock to the buyer. So what it means is the value of the stock increases. It's limited upside if you sell a call option, because your maximum upside is the premiums that you get from the sale of a call option. However, you also participate in all of the downside, because if the stock falls in value, you hold the underlying stock. So you're still going to participate in all of the downside. The only caveat is that you'll have the downside less the premium that you get. So you'll still receive the premium, but the buyer of that option is not going to cash it in because the value of the stock is less than the strike price. So there's no point in them buying it at a higher price than what it currently is. So you'll still get the premiums. So this works best in markets that are neutral to slightly bullish in outlook. It works well in ranging markets where it's less likely that a stock is going to go above its strike price, because that means that you're still going to receive the premiums from selling the call option, but you then don't have to sell the underlying stock, because the buyer of the option is never going to cash it in if it never hits the strike price by a set date. So this is how it can take advantage of volatility. So in a market that is moving sideways, which can be very frustrating to extract performance from, you can still generate good income from these covered calls. The downsides to doing this is that if you have a stock that goes on a massive rally, you can't participate in all of that positive growth because you're capped upside. When it hits the strike price, you have to sell the stock to the option buyer. And of course, if the stock falls in value, you still participate in all of the downside minus the premium. It's also going to take a lot longer to recover from crashes. So not only are we going to participate in nearly all of the downside when the stock crashes, when it then starts to recover again, because we have a capped upside, it can take a lot longer for the fund to recover compared to just simply holding a long-only version of the fund. You've also got to think about inflation as well. If the stock price stays exactly the same and you get the same yield, over time, that yield is going to be worth less. It's going to have its purchasing power eroded by inflation. So not only do you need to maintain a specific dividend yield, you also need the fund to continue to grow in value. so you don't lose the purchasing power of that income. So it all comes down to your risk tolerance. And this is probably not a fund that you want to put your whole portfolio into, but this could work well alongside other long-only ETFs. Like we mentioned, because it's got a capped upside, when it starts to recover or it goes on a massive rally, you're not going to participate in the upside. However, say this is 50% of your portfolio and the other 50% is in a simple global index fund. Well, then you've still got some exposure to that equity rally. So this is where a balanced approach can come in, where you've still got exposure to long-only ETFs, so you can participate in upside, but you've still got a good amount of income that's coming in on a monthly basis as well at a really good yield. I imagine as these continue to grow in popularity, more and more funds like this will start to appear. So it'll be really interesting in the next 2 or 3 years what happens in this space. In terms of other options and alternatives, when it comes to dividends, you're mainly down to these 3 that pay monthly. This one, the S&P 500, and the NASDAQ one. There are also bond funds which will pay out monthly, and it smooths the income so you get paid every month. But that's going to be another video in itself. So let me know if you want me to do one on bond ETFs that pay monthly. And let me know your thoughts on this fund as well. Thanks for watching. I hope you found that useful. I'll catch you in the next one.